Hello, folks. It is Monday, October 30th. It's about 7:30 in the evening on the East Coast of the United States. Actually, I did this video yesterday and forgot to share my screen. So let me share my screen and we'll get started. I'll be talking about gold in this video. We'll look at charts of gold and silver and talk about interest rates as well. This article was published yesterday evening. It's Jim Grant talking about higher interest rates for much longer than people are expecting. He's talking about a multi-decade bear market in bonds, and it's based on history. And so anyways, interesting article. And he's making the point that interest rates are rising everywhere in the world. It's not just the United States. It's not just the Western world. It's everywhere on the planet. And I believe the reason that is occurring, one of the reasons, primary reason, is that all of the countries on this planet at this point are using fiat currencies, and all of those fiat currencies have been debased to the point where they are essentially worthless. And everybody knows that they are worthless, and so nobody wants to buy sovereign debt. And so what they're having to do is raise interest rates in an attempt to attract legitimate organic buyers of their debt instruments. And so I believe that's why we're seeing interest rates rise around the planet. Embarked on a new bond bear market. This was interesting. It's the first time I'd seen this idea in print. And what Jim is saying here is that bonds, in contrast to other financial assets, tend to trend in multi-decade periods. And you don't see that in commodities and stocks typically, but bonds tend to move in long trends, secular trends, multi-decade. And then here's a comment on gold. He's saying that gold should not trade as an inflation hedge. Basically, it's an investment in safety. Basically, it's protection. You're buying insurance for your wealth. Whatever it is you consider to be your wealth, is stocks, real estates, whatever, bonds. Gold acts as a protection against monetary disorder, which, it's another way of saying monetary debasement, collapse of the fiat currencies, collapse of the debt markets. And so anyway, I thought that was interesting that not looking at gold as an inflation hedge, but as an investment in basically protection, insurance. He's making the point here that the speed of the rise in interest rates has been very fast, and that has caused disruption in the financial markets. And it has been. We've gone from essentially 0% rates to 5% rates in a very short period of time. In this paragraph, he's pointing out the multi-decade trends. And so falling rates from the end of the Civil War for 35 years, then we get a rise for 20 years, then we get a fall for 25 years, then we get a rise from 46 to 81. What's that? That's 25 years. So another 25-year trend. And then this trend that just ended was actually 41 years. That ended in 2021. And so anyway, if we look at the last 150 years in interest rates, they have trended in cycles of 20 plus years. That's bond and bull and bear markets, each one at least 20 years in length. And so anyway, this is a interesting article. I'll include a link to it in the description below this video. Let's jump into the charts. This is the yield on the 10-year note in the monthly time frame. We've looked at this chart before, and I just wanted to illustrate what Jim is saying in the article. So this is the 41-year downtrend that ended in 2021. And one of the points I like to make with this chart is that this is a decisive change in behavior. This is not an overthrow, a brief jump out of the channel, and we're going to pop back into the channel. That's not what we're looking at. This is a decisive change in behavior. And based on what Jim was just saying in that article, it would not be surprising if this was the start of an uptrend that could last for 20 years or more. And so another thing we can see in this chart is that from January of 63 to September of 1981, we had a rising trend in interest rates, and that's 18 years. And according to Jim's article, this uptrend actually started at the end of World War II, started in 1946. So actually longer than what we're seeing here. It's just, that's all the data I have. That's all the data that TradingView gives me for this particular vehicle. So anyway, that's just illustrative of what Jim is saying in that article. So on Sunday, that's this red candle here, Israel had gone into Gaza. And so when the markets opened Sunday evening, we got a big pop higher in gold and silver. And then today, obviously, we can see got a little bit of a pullback. The pop up on Sunday took gold above 2,000, and let's see where we're at currently, 2003. So this is COMEX, so gold futures, and we've still got 2003. I believe the forward contract here is still December. So we're looking at, I believe, December gold futures currently at $2,003. MACD in bull mode on a buy signal, energy very elevated. So bullish chart, not terribly surprising that we're getting a pullback from that. You know, it was a poke up into this prior high and then a pullback from that level. This is spot gold. And so again, that red candle, that's Sunday. So we got a pop up to a high of 2006. And now today we're at 1995. So we popped over 2000, currently back below that level, 1995, at the time I'm recording this video. Notice that MACD is reaching the level of being overbought based on this prior high. Now that doesn't mean, you know, price can't go higher, MACD can't go higher. It just suggests that in this time frame, gold is overbought at this point. Energy very elevated. So potential target here would be back down to, that's 1987 was this peak. We got a little bit of a horizontal support level at 1987. So quite possibly a pullback to that level. Looks like it would be coincident with the 20-day moving average. And then maybe we see some more sideways action or potentially a push higher. One of the things we have to keep in mind is that a lot of this movement in gold is based on geopolitics. And typically when gold moves higher based on geopolitical tension, we don't keep those gains, that they tend to fall off. And so it wouldn't be surprising to see gold correct some of this move. Although geopolitical tension obviously is still quite high. We've got two conflicts at this point, tremendous amount of war material being transported from the United States to the Middle East. I think last I saw there were 93 C-17s, and the C-17 is a huge aircraft. It'll carry almost 80 tons of cargo, and so 93 of those have gone from the United States to the Middle East, and they're distributing air defense systems, who knows what. But that's a lot of tonnage headed into that theater. And so anyway, geopolitical tension has not eased, and so wouldn't be surprising to see gold hold on to these gains and potentially move higher. Let's look. This is the weekly time frame in spot gold. So basically playing at this 2000 level. Notice that MACD has popped up into bull mode, suggesting that the primary trend is to the upside, currently on a buy signal and a new buy signal. So just in the last 2 weeks, that's a new buy signal in MACD, energy very elevated. So bullish chart there. In the monthly time frame, a couple of things that I find significant. Basically, this month's price bar, so we've got one more day. Tomorrow is the last day of the month. But currently, this is an impulsive price bar. And looks like we're at this point, if we close today, we'd be at the top of this pattern. We'll see where we close tomorrow. But anyway, impulsive price bar, meaning that it is closing very near the high of the bar, and it's a relatively large bar is another way to measure impulsivity or high energy, is that we get a large price bar relative to the other price bars on the chart. These are little bars. That's a big bar. And then MACD in bull mode, suggesting primary trend is to the upside, and then elevated energy. So bullish gold chart in the monthly time frame. Silver is kind of a mess. We need to keep in mind what Franklin Sanders told us about how the hedge funds tend to trade the precious metals when, excuse me, when they're taking positions based on geopolitical tension. They tend to go long gold and short silver. And so that could explain why we're seeing gold rise and this downtrend in silver. Now, of course, on Sunday, silver did pop higher, pulled back from that level, currently playing with resistance, working on resistance at the 200-day moving average. So nice volume, buying volume coming in on that move. MACD is moving up into bull mode on a buy signal. Energy is elevated. So silver is looking good overall. It doesn't look as bullish, quite as bullish as gold. And obviously it's got resistance at the 200-day moving average to deal with. Oh, and so that was gold futures, COMEX. So again, December contract, where are we at currently? 23.42. So silver at 23.42. This is spot silver at 23.29. So just about the same. Working on resistance at the 200-day moving average, bull mode, buy signal. So basically the same as the COMEX chart. Silver in the weekly time frame, not very exciting. Sitting on what could be support at the lower median line of this modified shift pitchfork. playing with resistance and support. The 10-week and 40-week moving averages, got this horizontal support resistance zone. MACD currently in bear mode on a sell signal, looks like it's trying to turn up. Energy is somewhat elevated. It's in the top half of the range. Silver in the monthly, just sideways action. Nothing exciting there. Note that we're in bull mode in MACD. Energy is elevated. So the US dollar, and we're going to look US dollar and 10-year note. And the reason we're looking at those when we're talking about silver and gold is that they typically act as headwinds for the precious metals. So when the dollar is strong, precious metals tend to be weak or weaker than they might have been otherwise. And then when interest rates are rising, the precious metals tend to be weak. And so the dollar in the daily time frame, this is a fairly bullish chart other than we're overbought based on MACD. Really, that's the only negative about this chart. Currently we're in sideways consolidation, but overbought. It's not surprising that we're consolidating instead of moving higher. So let's look at this chart. This chart is actually very bullish and suggests to me that the dollar wants to move higher at this point. It's a sideways consolidation. We can think of this smaller gray box here that I've got highlighted as a flag or a pennant. What Tim Morge, the way he would describe that, is a price coil. That basically price is coiling or gathering energy for its next move. And when it moves out of this coil, this sideways consolidation, the move is likely to be impulsive, high energy. Now, we can't say definitively which direction that move will occur, but based on everything else in this chart, it's reasonable to assume that move will be to the upside. We've got 10-week moving averages above the 40-week, prices consolidating above a support level, MACD's in bull mode on a buy signal, energy is very elevated. This is a bullish chart, which again suggests to me that the dollar is going to head higher. So, and as I pointed out numerous times, one of the things Richard Russell said repeatedly about the US dollar is that as the world's reserve currency, and because most financial assets are priced in the US dollar, people around the world are essentially short the US dollar. It's a synthetic short. And that's the term that Richard used repeatedly, was synthetic short in the US dollar. And so as the financial system unwinds, deleverages, collapses, whatever word you're comfortable with, we are in the midst of a global financial collapse. Believe it or don't believe it, watch it happen. Pop some popcorn and watch it happen. But anyway, as the financial system around the world unwinds, it won't be surprising to me to see the dollar go higher. Basically, unexpected strength in the US dollar, because people have a synthetic short. To unwind their financial positions, meet their margin calls, they have to buy dollars to unwind their positions. And that buying of the dollar creates demand. Dollar goes higher when demand increases. So anyway, that would be my expectation, is a higher dollar ahead of us, which of course is a headwind for the precious metals. Yield on the 10-year note, what I believe occurred here is that we pushed up into the 5% level, which is a round number. And of course, traders, the way as a trader, the way you handle round numbers, that if you were long, this would be a natural place to take profits, partial profits, full profits. Anyway, you would look at a round number with an expectation that price would react at that level. And as we can see here, it did. And so anyway, yield pushed up to 5% and then pulled back. So again, as a trader, you would take profit. Not surprising that traders would take profits at that level and potentially reverse their positions and go short. Or if you're a short only trader, that would be a level where you would choose to enter your shorts, as expecting a reaction at the round number. And so anyway, that's exactly what we're seeing here. If we look at the daily time frame, there's the push up into 5% and then a pullback from that level. We're currently getting a sideways consolidation at that level. But notice that it is a sideways consolidation, not a pullback, not a correction, basically just price hanging out at this high level and moving sideways. So MACD still has a ways to run before it reaches an overbought level. Energy is very elevated. And so this chart is bullish, other than overbought. Price is overbought relative to the 10-day moving average, or 10-week, and then certainly overbought relative to the 40-week. So overbought, but suggesting higher interest rates to come. We've got an FOMC meeting coming up. I believe it's next week. Expectation is that the Fed will hold steady. That's what the ECB, they just had a meeting and they held steady on interest rates. Expectation is that the Fed will do the same. But we need to keep in mind that they've given themselves cover. They actually have two reasons to continue hiking rates if they choose to. The first reason is strong economy. And that's air quotes around strong economy. The economy is not strong. What they're pointing at is GDP. And so when we look at GDP numbers, we have to keep in mind that all of the financial machinations that we engage here in America, that gets added into GDP. And so one of the reasons that GDP is hot right now is because the government is borrowing and spending so much money. Well, when you're printing fiat currency to make your economy look strong, to buy your own bonds, that is not an economic strength. But anyway, they have given themselves cover for continuing increases in interest rates by claiming that the economy is strong. And then the second factor is the fighting inflation, which of course they're not fighting inflation. They're trying to attract legitimate buyers of their debt instruments by continuing to raise rates. And so anyway, expectation that rates will hold flat, but they've got two reasons to continue raising rates, and we'll just have to wait and see what they do. That's all I've got in this video, folks, and I'll talk to you in the next one. Hello.